Welcome to this edition of Wealth Dynasty. Today we're going to do an overview of term insurance and do a little bit of a dive into the practical application and uses of term insurance, pros and cons, and how term insurance can help you in your overall life insurance strategy.
All right, welcome back to Wealth Dynasty. Glad to have you back. Today we're going to be talking about life insurance, a lot of different types of life insurance. In fact, we're going to go over all the major types of life insurance, the subtypes, and then we're going to go into detail on who should get those, when you should get them, why that would be applicable at different times in your life. So going to be a great episode today. This is going to be a high-level overview, and then we'll have subsequent episodes that are going to go into a lot more detail about each of those subtypes.
Awesome, Mark. Thanks for being here today and looking forward to talking about this. This is an important subject. Life insurance, unfortunately, is a complex product, lots of options here in the United States. And we're going to try to drill down and give an idea of what to expect overall.
Correct. Yep. All right. So there's two major types or two main types of life insurance, and those are term life insurance or term insurance and whole life or permanent insurance. And we're going to go a deep dive into each of those the subtypes or categories of each of those types of insurance today. So let's start with term. Tell us a little bit about term insurance.
Yeah, so term is one of the main categories of life insurance. And term, as the name implies, is for a period of time, a term of time. So term is a contract that guarantees coverage for a certain period of time. So it could be as little as a 1-year term. It could be a 5-year term, 10-year, 15, 20, 30, and even now you can get up to 40-year term on some carriers. And so what it means is that for that period of time, you have a guaranteed premium. And if you pass away in that period of time, the claim will be paid. But if you live longer than that term period, then the contract changes, and either you'll have a greatly reduced benefit or a substantially higher premium for that same coverage.
And why would somebody, I guess generally speaking, choose a term insurance? Why would that be a good option for some people?
So term insurance has many applications, many uses. It's great for young families just getting started, especially at the younger ages. The term insurance is very inexpensive, and you can get quite a bit of coverage for very little money. Also, businesses can use term insurance. It's a useful product for buy-sell agreements, for key person coverage. For buy-sell agreements, maybe the business is expected to be together 10 years. Maybe the plan is to sell the business in 10 years. Or 5 years. So the idea would be to purchase coverage that would last the 5 or the 10 years or 15 years, whatever that period of time might be. And then because there's no reason to buy coverage that's going to last longer than that, when hopefully the partners are young enough and healthy enough to get it at a very low cost.
Now, is that the same as like a key man insurance, or is that something, or is that?
It can be a key person coverage. In other words, the company could purchase coverage on a top executive or a top producer to protect the company if something happens to that person. So key person is really to protect the company for the loss of an important employee or partner.
And that could be used if somebody was buying a company from another and needed that person as either a mentor or somebody to help.
Correct. That's absolutely correct. So in other words, it could be a transitional situation. So if you have a mentor and you want coverage on that mentor until their term of service is ended, term of policy would be great. But it's got lots of uses, and as I mentioned, it's got many lengths of time that it can last for. But it's typically term insurance is simply a very simple contract. There is no cash value, and if you die during that period of time, the benefit is paid. If you do not die during that period of time, then there is no benefit, or it's a substantially higher premium. a couple other things about term insurance. So some term insurance, if you have a really good company, can be converted into a permanent policy without additional medical questions in the future.
And what is that policy? What's that called?
Well, it's just a convertible term, and most policies are convertible for a period of time. What you've got to look for is some term companies really don't offer much in the way of permanent coverage. So their conversion options are not that valuable. Other companies do have great permanent products, and that conversion option is then useful and valuable. But the term conversions these days are typically 6 or 7 years, but from the time you purchase the policy. Some companies will extend that time out quite a bit, the term of the policy. So some companies go 15, 20 years on the conversion option, maybe up to age 65 as a limit. And then if you wanted to, you can convert all or part of the term insurance into permanent insurance without any medical questions. That can be quite valuable. So if someone's in their 30s, they get a super preferred rating, they could convert that coverage, 10 years later to a super preferred permanent coverage, and even if their health has changed.
That's pretty crazy.
Yeah. So in other words, they may probably going to live past the term, the initial term, but by getting the conversion, it'll last the rest of their life, but they'll be able to buy coverage at super preferred or preferred, whatever their rating was originally, even though they probably would not normally be able to get that in their current situation.
Perfect.
Another type of term that sometimes we speak about is return of premium. So ROP, return of premium. And there, typically that's going to be a 20 or 15 or 20 or 25-year term where you're going to pay additional premium with the promise that if you live the full term, the total premium will be repaid to you at the end of that term.
So what would the advantages, I guess, who would want to get a return of premium policy? Like what would ideal situation be for that?
I think that's more of, I'm not sure that there's any special circumstances. It would really be more what the client prefers. So a client may decide, well, I'll pay the extra premium knowing that I'm going to at least get my money back at the end of the term. Okay, so in a way, it's a little bit of a savings. It's certainly not a great return on that money, but at least the money comes back to you. You don't feel like it's completely lost to you, but you are paying additional for that. And sometimes it's better just to buy the permanent coverage.
No, yeah, I guess that was my next question. What would those quotes, like, are they pretty comparable to just buy permanent since you are younger and you'd probably get a reduced rate?
You had to compare each one. It's typically going to be less expensive than permanent, but considerably more expensive than term. It's kind of in between there.
That's good. So we talked about convertible term. We talked about return of premium. What other type of term products are there out there?
Well, there used to be a mortgage insurance, or called decreasing term. You don't see that very much anymore. That was a coverage where you'd have a mortgage and then you would buy a term policy equal to that mortgage, but the coverage would decrease over the years.
Was it based on the amortization scale? Or
it's not really based on the amortization scale of the mortgage because it's a separate contract, but it kind of mirrors the mortgage to some degree.
Okay.
So that in 30 years, there's really no coverage left, or 20 years, whatever the time period might be.
That makes sense.
Yeah. Those were rather expensive products, actually, surprisingly expensive for the type of term that you had. Yeah.
Now, was that required by the banks, or was that something that somebody would elect?
That's something people elect. The banks don't require typically any kind of death benefit associated with a mortgage because they have the house as collateral.
Yeah, correct.
Yeah.
Besides that, any other term insurances that you can think of, or?
Well, some term insurances now have special riders that will provide a critical illness benefit, meaning that if you had a heart attack or stroke or cancer came upon you during the term, then they'll pay a cash benefit in addition to the death benefit.
No, in addition, so that's not going to take away from
It depends on the contract. It depends on the contract.
Yeah.
Okay.
And those are riders that you would put on a regular term
Correct.
policy.
Right. Some term policies you can add child riders so that you have a larger policy on the breadwinner, maybe a spouse rider if it's more of a traditional family situation. And then you have child riders so that if something happens to the kids, there might be a $10,000 benefit. Say the breadwinner had $1 million policy, the spouse rider might be $250,000, and then the children rider $10,000 or $15,000. They can be built onto the contract.
Now, with those riders, let's say like I'm maybe a young family, just, and I'm not done having kids yet, but I'm getting the policy now. Would I have to requalify every time we had another child, or how does it work?
That's a great question. So some of the policies, it's just it's a child rider. It covers all the children. Okay. Others have to specify each one.
Okay, that's interesting. So and so some policies, in theory, I guess you would be able to have additional children, and they're automatically going to be covered as.
That's my understanding. Yeah. I haven't looked at that for quite a while, quite frankly, but if I recall, that used to be a possibility. Another category, of course, is group life insurance, which many people have through their employer. It may be as little as 25,000. It could be as much as a few million, depending upon the employment contract and what the benefits are offered by the company. Some companies offer 1 or 2 times salary as a base benefit. Others, and then you can buy up to another 5 or 10 times salary of group term. So those are, good contracts. Of course, they only cover you while you're still employed at that location. If you change locations, then of course that term coverage ends. They do have some convertibility, but those conversions are quite expensive, and they assume you're in terrible health. And so to buy those conversions to a whole life, it's a huge jump in premium.
Yeah.
Because there's one thing that's kind of interesting about group life is that so it covers a lot of people. They're not individually underwritten, which means that healthy people are lumped in with not so healthy people, which means that the group life company is charging for that. They're charging under the assumption that there's some people that aren't healthy in that group. So typically, a person can, if they're in good health, can purchase individual coverage that may be less expensive over a 10 or 15-year period than the group life. The group life tends to go in age bands of about 5 years. So your premium right now for the 100,000 of coverage might be less than if you bought an individual policy. But if you look at the 5-year bands, by the time you're 15 years out, you're much better off buying an individual policy, because in 10 or 5 or 10 or 15 years, the bands have increased, and it's no longer a great deal.
Yeah, that's a good point. It could be a good option for people that are in very poor health. And then at the same time, it's not the best idea if you're in incredible.
Right. Yeah. For people that are poor health, it's a fantastic benefit.
That's good. Now, one other thing that I do have to say about that, I have a friend that passed away last year, and he had this, and on his salary was basically that it only covered, and this may be different from company to company, but it only covered his base salary, and he worked on the oil fields in Texas, and so he got a lot of overtime. Over half of his compensation was overtime and bonus and all the extra stuff he was doing. None of that was covered, and it was one single year, and so it was very, very minimal to have just a standalone thing. So, and then just like you said, if you become uninsurable, you leave the company, all those those benefits do not go with you, or if you do opt to continue that coverage, it's going to be a significantly higher rate. So
Right.
definitely, that's always an excuse, I think, for people like, oh no, I have insurance through work.
Right.
Like,
You do, but you don't.
yeah, like there's a lot to look at with that.
Right.
And think about, because what is your coverage need? It's probably not what your salary is or your base salary without overtime and other bonuses. So definitely worth looking at there.
Yeah. I mean, a basic rule of thumb, and this is not exact for every person, but if you're a breadwinner, you want about 10 times your income in coverage to protect your family. That's about the right number.
Why is that?
Well, the idea of life insurance is to replace income. Assuming you have other coverage or you have some savings, most people, about 90% of the time, the right number is about 10 times their income. So let's say someone's making 100,000 a year, they need about $1 million of coverage. That $1 million of coverage will create about $50,000 a year of income. So we're only replacing with half the income.
And that would be like just living off the interest without touching
Correct.
that $1 million.
Correct.
Okay.
Yeah. So it just replaces, that's the idea behind it right now. The other way you can look at it, I'm going to replace the income for 10 years. Okay. Which is not bad. $1 million does replace the income for 10 years.
10 years, yeah. But
A little longer, actually, because of interest.
For sure.
Yeah.
For sure.
Yeah.
It would be good to.
And that's a good starting place, right? In other words, 10 years is a good ramp up to improve your situation.
Correct. But
and overcome the loss.
yeah, there's lots of factors. And I think having a tailored plan or having something that sitting down with a professional and really looking at those numbers, looking at your financial situation, digging deep into where you're at and where you want your family to be at, what your family's goals, like besides replacing my income, I got to put kids through college,
Right.
and I want my kids to go to this school. Like you got to run all those numbers. How much has inflation been from college over the last 20 years? How much is it going to be over the next 20 years if my kids are small? So lots of factors to take into account. That $50,000 replacement income gonna maintain your current lifestyle? Maybe not.
Yeah.
So you got to think about your lifestyle too and how comfortable you're gonna be going back to work if you haven't been to work for a while. A lot of stuff to think about there.
Right. So term insurance is valuable. It's useful. It's not perfect because it has a time limit. And the truth is about 98% of the people live beyond the time limit.
Wow, that's interesting.
Only about probably less than 2% of term policies end up in any kind of claim.
Wow. See, that's what they don't tell you.
Right.
Yeah, we'll get your money. And it's great to have the coverage, but at the same time, it's just like car insurance. Like I hate having car insurance because I don't plan on getting in accidents and I don't like shelling it out every month, but I have to have it.
Right.
So we talked a little bit about those additional riders, or if people could, take some money out of a term policy. Would that include like cancer or heart attacks or like?
Oh, so
Yeah.
so critical illness typically refers to a heart attack, some type of cancer. Some cancers are excluded, like squamous cell or basal cell. Those are typically not going to be part of the critical illness coverage. When I say stroke, like heart attack, all those sorts of things.
Major,
Yeah, major. It could be, kidney failure or something like that. But those kinds of episodes that may not kill you off right away, but they slow you down. It creates financial havoc because loss of work or loss of income. There's typically some lump sums that help out.
Yeah, and with that additional expenses, I know when my dad was going through cancer treatments, it wasn't just the fact that he couldn't keep working. He also had to shell out, all the money to drive 3 or 4 times out of state to go to a facility that he wanted to go to or whatever. So yeah, there's a lot of additional expenses there.
Yeah.
So
And some term policies actually have chronic illness riders, meaning that they can access the death benefit for chronic illness, meaning loss of the ability to perform 2 of the 6 daily living activities or a cognitive dysfunction.
what are those 6 that you're talking about?
I'll see if I can remember them. So it's toileting, bathing, transferring, eating,
Dressing is one.
dressing, and I can't remember the last one. I always forget the last one. I can remember 5 always.
There's at least 5. So if you couldn't do that by yourself, then that would be a qualifying 2 of those, 2 of the
Right.
6. That would be a qualifying event. We'll put those
Oh, continence is the last one. Okay,
continents.
yes.
Yeah, that's important.
Okay, yeah,
Can't hold it.
yeah. But you got to question, in my mind, I question, is that really a valid rider? Because you got a term policy, it's a 20-year term, 98% chance you're going to live past it. You probably won't have any kind of claim on it. You're paying money for something that's
Extra money to have that.
extra money to have that. And it just, in my mind, the likelihood of that happening is small. I think it's more of an emotional comfort to have that. Not that it couldn't happen. It can happen for sure. And it does happen, but you got to look at the extra premiums. Is it worth it?
Yeah, and the thing about all those situations is those would automatically make you uninsurable. If you became stroke, cancer, heart attack, all that, you're uninsurable at that point. So if that's something that is a risk factor in your family, that's something to definitely think about. Run the numbers.
Yeah, because term insurance, it's hard to get term insurance that lasts past age 70, 75,
Mm,
when most of these claims occur
in the later years.
in later years.
Yeah.
Yeah.
Let's talk about the annual renewable term. What is that? Why would somebody want that? Is that just
Well, that's actually a pretty useful term. Annual renewable term is the least expensive type because it's each year. You're going to have a little bit increase in premium each year. If you look at it, average it out over 10 or 20 years, it's about the same as having a 10 or 20-year term. But you paid less at the beginning and a little more at the end. Okay, so inflation is like it's the same. 6.5 does the other, but the annual renewable term can be especially helpful. If someone's just starting out
really on a budget?
on a budget, it can be helpful. I mean, or you need a lot of insurance. Maybe you're a doctor just starting out, or you're in residency. You want to protect that future possibility of income,
Yeah.
and but your budget's low right now.
Yeah, and luckily for all of our doctors that are listening, if you do pass away, knock on wood that doesn't happen, but your student debt goes away. I know a lot of our friends that have $500,000 in debt coming out of college for being a doctor. I mean, they're gonna make it back, but it's a lot of money.
Yeah.
So
It's a big investment.
it's a huge investment of time and sacrifice. So.
Today, thank you for listening today to Wealth Dynasty, our talk about term insurance. I hope you've learned a few things that are helpful to you as you plan for your own life insurance situation. We look forward to being of service to you and invite your calls and emails, any questions you might have. Thanks so much.